Here's a controversial investing truth that most people get completely wrong. Buying stocks at all-time highs is actually one of the smartest strategies you can use. While everyone else is waiting for the perfect dip or trying to catch falling knives, the most successful investors are doing the exact opposite. They're buying strength, not weakness. Before we dive in, let me be crystal clear. This is purely educational content. I'm not a financial advisor, and nothing in this video constitutes financial advice. Every investment carries risk, and you could lose money. Always do your own research, understand your risk tolerance, and never invest money you can't afford to lose. Consider consulting with a qualified financial professional before making any investment decisions. I know this sounds counterintuitive. Your brain is screaming, buy low, sell high, right? But what if I told you that academic research spanning decades shows that stocks hitting all-time highs have a statistically higher probability of continuing higher than stocks that are beaten down? What if the conventional wisdom is not just wrong, but completely backwards? Today, I'm going to break down exactly why buying all-time highs works, show you the data that proves it, walk through real examples of massive winners, and yes, I'll also cover the drawbacks and risks you need to understand. By the end of this video, you'll have a completely new perspective on market psychology and momentum investing. But first, let me ask you a question. Would you rather buy a stock that just broke out to new highs with massive institutional buying behind it? Or would you rather buy a stock that's down 50% because it's cheap? Your answer might surprise you by the end of this video. The psychology behind all-time highs. Let's start with why this strategy feels so wrong to most people. It's because of a psychological bias called anchoring. When you see a stock at $100 that used to trade at $50, your brain anchors to that lower price and thinks $100 is expensive. But here's the thing. The market doesn't care about your psychological anchors. The market only cares about future earnings, growth, and momentum. Think about it this way. When a stock hits an all-time high, what does that actually mean? It means that literally every single person who has ever owned that stock is now making money. There are zero bag holders. Nobody is sitting there thinking, I just need to break even and I'll sell. That selling pressure simply doesn't exist. Compare that to a stock that's down 50%. Now you have massive psychological selling pressure from everyone who bought at higher prices. Every bounce becomes a selling opportunity for people trying to minimize their losses. That's a very different dynamic. But the psychology goes even deeper. All-time highs often represent what's called blue sky territory. There's no overhead resistance because the stock has never traded at those levels before. Traditional technical analysis breaks down because there are no previous support and resistance levels to guide you. The stock is literally writing new price history. This is where momentum comes in. Newton's first law doesn't just apply to physics, it applies to markets too. Objects in motion tend to stay in motion unless acted upon by an outside force. Stocks that are trending higher tend to keep trending higher until something fundamental changes. The legendary trader Jesse Livermore understood this over 100 years ago when he said, "It is not good buying that makes money in stocks, it is good selling that does. But good buying is essential to good selling." He made fortunes buying breakouts to new highs, not trying to catch falling knives. Academic research and data. Now let's get into the hard data because this isn't just theory, it's been proven academically. Multiple studies have shown that stocks hitting 52-week highs outperform the market significantly more than stocks hitting 52-week lows. One of the most comprehensive studies was conducted by researchers at the University of Michigan and published in the Journal of Finance. They analyzed over 80 years of stock market data and found something remarkable. Stocks that hit new 52-week highs had an average return of 0.024% per day over the following year, while stocks hitting 52-week lows averaged negative 0.007% per day. That might not sound like much, but compounded over a year, that's the difference between making money and losing money. The high momentum stocks significantly outperformed both the market average and the low momentum stocks. Another study by George and Huang found that stocks near their 52-week highs generated average annual returns of 16.9%, while stocks near their 52-week lows averaged just 5.8%. That's almost 3 times better performance. But here's what's really interesting. The effect is even stronger for stocks hitting all-time highs versus just 52-week highs. When a stock breaks through its previous all-time high, it's signaling something fundamental has changed about the business or industry. That kind of breakout typically leads to even stronger performance. The research consistently shows that momentum is one of the strongest factors in equity returns. Eugene Fama, Nobel Prize winner and father of the efficient market hypothesis, even had to acknowledge that momentum represents one of the biggest anomalies in his theory. Markets aren't perfectly efficient, and momentum is the proof. What's driving this momentum? Several factors. Analyst upgrades tend to follow price momentum, institutional investors pile in as stocks break out, and retail investors finally notice stocks after they've already moved significantly higher. It creates a self-reinforcing cycle that can last months or even years. Real-world examples of winners. Let me show you some real examples of how this plays out. These aren't cherry-picked examples. This pattern repeats constantly across different time periods and market sectors. Take Apple, for instance. In 2012, Apple was hitting constant all-time highs as the iPhone business exploded. People kept saying it was too expensive at $25. That's split-adjusted pricing. But the stock kept climbing to new highs month after month. If you bought Apple every time it hit a new all-time high in 2012 and 2013, you would have made enormous returns as the stock eventually reached over $190. Or look at Amazon during the 2010s. Every year, financial media would publish articles about how Amazon was overvalued and due for a correction. Yet the stock kept hitting new all-time highs year after year, from $200 to $300 to $500 to over $1,800 at its peak. Investors who bought the expensive all-time highs consistently outperformed those waiting for the perfect entry. NVIDIA is another perfect example. In 2016, NVIDIA broke out to new all-time highs as their AI and gaming business exploded. People called it overvalued at $30, then $50, then $100, then $200. The stock eventually peaked over $500 before the recent split. Every single all-time high along the way was a buying opportunity, not a selling signal. What do all these examples have in common? They represent companies experiencing fundamental business transformations or operating in rapidly growing industries. The all-time highs weren't just random price movements. They reflected real business momentum that was being recognized by the market. The pattern is clear. When companies are executing at a high level and operating in growing markets, their stocks tend to trend higher for extended periods. All-time highs become launching pads for even higher prices, not ceilings. Why all-time highs work? The institutional factor. Here's something most retail investors don't understand. Institutional investors, the pension funds, mutual funds, and hedge funds that control trillions of dollars, have very different buying patterns than individual investors. Institutional investors typically don't try to catch falling knives or buy beaten-down stocks. They buy strength. They buy momentum. They buy stocks that are already working. Why? Because they're managing other people's money and need to show consistent performance. It's much easier to justify buying a stock that's hitting new highs and showing strong fundamentals than explaining why you bought a stock that's been declining. That's a very different dynamic. But the psychology goes even deeper. All-time highs often represent what's called institutional accumulation. When a stock starts hitting new all-time highs, it gets noticed by institutional research teams. They start coverage, issue buy ratings, and begin accumulating positions. This buying pressure from large institutions creates significant upward momentum that can last months or even years. There's also what's called the index inclusion effect. When stocks hit new highs and their market caps grow, they often get added to major indexes like the S&P 500. Index funds then have to buy these stocks regardless of price, creating automatic buying pressure. Professional momentum investors understand this dynamic. They're not trying to outsmart the market. They're trying to ride alongside institutional money. When institutions are buying, they want to be buying. When institutions are selling, they want to be out. This is why technical analysis works so well with momentum strategies. Chart patterns like breakouts, flag formations, and descending triangles are really just visual representations of institutional accumulation. The charts don't predict the future, they reveal what smart money is already doing. Consider also the role of analyst coverage. Stocks hitting all-time highs start getting attention from Wall Street analysts who previously ignored them. New coverage typically means buy ratings, which brings in more institutional investors, which drives prices higher. It's a virtuous cycle that can continue for extended periods. The drawbacks and risks. Now, let's talk about the risks, because this strategy definitely isn't perfect. The biggest risk is obvious. You're buying at the highest prices in the stock's history. If you're wrong about the momentum continuing, you can face significant losses very quickly. The first major risk is what I call false breakouts. Sometimes stocks will hit new all-time highs, but then quickly reverse. This often happens when the breakout is driven by short-term factors rather than fundamental business improvements. You might buy the breakout only to watch the stock fall back below its previous high within days or weeks. Valuation risk is another major concern. Stocks hitting all-time highs are often expensive by traditional metrics like price-to-earnings ratios. If market sentiment shifts or growth slows down, these high-valuation stocks can fall much harder than the overall market. Think about what happened to many growth stocks in 2022 when interest rates rose. Sector rotation risk is also an important factor. Sometimes entire sectors become momentum favorites, like tech stocks in the late 1990s or clean energy stocks in 2020-2021. When sentiment shifts and money rotates to other sectors, all the momentum stocks can decline.
Psychological risk might be the biggest challenge. It takes incredible discipline to buy stocks at all-time highs when every fiber of your being is telling you they are too expensive. Most investors simply can't overcome this psychological barrier. They end up buying after the stock has already fallen significantly, which defeats the entire purpose. There's also the risk of momentum crashes. When momentum stocks finally turn, they can decline very rapidly. Institutional investors who were buying on the way up become sellers on the way down, creating the opposite momentum effect. Stocks that took months to climb to new highs can give back those gains in weeks. Market environment matters too. Momentum strategies work best in uptrending markets where risk appetite is high. During bear markets or high volatility periods, momentum can reverse quickly as investors become risk-averse. Implementation strategy and risk management. So, how do you actually implement this strategy while managing the risks? First, you need strict criteria for what constitutes a valid all-time high breakout. Not every new high is worth buying. Look for stocks that are breaking out on strong volume, at least 50% above average daily volume. This indicates institutional participation, not just random buying. The breakout should also be accompanied by strong fundamentals, growing earnings, expanding margins, and a compelling business story. Diversification is critical. Never put all your money into momentum stocks. They should be maybe 20–30% of your portfolio at most. The rest should be in more stable, diversified holdings. This way, even if your momentum picks don't work out, your overall portfolio stays protected. Use stop losses religiously. I typically use a 15–20% stop loss on momentum positions. If a stock breaks out to new highs, but then falls 15–20% below my entry price, I sell immediately. No exceptions, no hoping it will come back. Momentum is about being right quickly. If you're not right quickly, you're probably wrong. Position sizing is also crucial. Start with smaller positions when you're learning this strategy, maybe 2–3% of your portfolio per stock maximum. As you get more experienced and comfortable with the volatility, you can potentially increase position sizes. Consider using a systematic approach. Maybe you buy stocks that hit new all-time highs while also meeting certain fundamental criteria. Screen for companies with accelerating earnings growth, expanding profit margins, or operating in growing industries. This helps filter out the low-quality breakouts. Finally, have a plan for taking profits. Momentum can reverse quickly, so consider taking partial profits as stocks continue to advance. Maybe sell 25% of your position after a 25% gain, another 25% after a 50% gain, and so on. This allows you to participate in continued upside while protecting some gains. Conclusion and action steps. Here's the bottom line. Buying all-time high stocks isn't just a valid strategy, it's one of the most consistently profitable approaches backed by decades of academic research and real-world results. The key is understanding that markets are driven by momentum and psychology, not just fundamentals. But let me remind you again, this is educational content only. I am not providing financial advice or recommending specific investments. Every strategy has risks, and past performance doesn't guarantee future results. You could lose significant money using any investment strategy, including this one. Before implementing anything discussed in this video, do your own thorough research. Understand your personal financial situation, risk tolerance, and investment timeline. Consider paper trading or using very small amounts of money while you learn. Most importantly, never invest money you can't afford to lose. And strongly consider consulting with a qualified financial advisor who can provide personalized advice based on your specific circumstances. Yes, it feels uncomfortable buying stocks at their highest prices ever. Yes, there are real risks you need to manage. But the data is clear. Stocks hitting new highs are more likely to go higher than stocks that have been beaten down. If you decide to explore this strategy after doing your own research, start small. Pick one or two high-quality companies that are hitting new all-time highs with strong fundamentals and growing businesses. Use proper position sizing and stop losses. Track your results and learn from both your winners and losers. Remember, this isn't about being right on every trade. It's about being right more often than you're wrong and managing risk when you are wrong. The best momentum investors have win rates around 50 to 60%, but their winners are much bigger than their losers. The market rewards companies that are executing at high levels and punishing the ones that aren't. All-time highs are often the market's way of telling you which companies are winning. Sometimes the best investment advice is the simplest. Buy what's working. What do you think? Have you ever bought stocks at all-time highs, or does it still feel too risky? Let me know your thoughts in the comments below. And remember, always do your own research before making any investment decisions. Important disclaimer. This content is for educational purposes only and should not be considered financial advice. The creator is not a licensed financial advisor. All investments carry risk of loss, including potential total loss of principal. Past performance does not guarantee future results. Always conduct your own research and consider consulting with a qualified financial professional before making investment decisions. Never invest money you can't afford to lose.